Okay, a lot of good questions this week, but for time constraint, I can't get to them all. But I think I get to about 20 of them. Here are two basically on the same topic. First one, Warren Buffett and Charlie Munger stress that volatility is not risk. That is true. Volatility is a measure of risk, is one measure of risk when there's risk. Risk is something you can't see, touch, or feel, so we have to have some way of measuring it, so we measure it in terms of volatility. Risk is inherent to the business in which one is invested, not the movement of price of that business. Well, it depends on what you're measuring. So I'll answer that question down here, and I'll show that, yes, they do care about volatility. They just don't care about it in a direct way. They care about it in a transitive way. Does Buffett Munger's view contrast or complements this week's discussion on dollar delta beta? No, it doesn't. It just moves it closer to the actual decision maker. So what do? They buy businesses. That's what they're known for. They invest in businesses. They have large positions in businesses, but they're really known for buying complete businesses, investing in businesses. And what do they always say about management? Find good management. Well, good management cares about volatility. Good management does all of the complex calculations and risk management that they don't have to. So transitively, they don't have to do something that they've bought good management to take care of. So have a look at this down here. Let's say that you have a private business. Well, there are volatility of revenues. You can lower that by diversifying your revenue streams. There's diversification, right? Volatility of input costs. Well, you can lower that volatility by hedging. So you're reducing your risk of hedging. You're reducing the risk of your revenues by diversifying your revenue streams. Volatility of cash flows. Volatility of net income. So there's a lot of volatility that management pays attention to. These are all elements inherent to the business, all captured by a risk measure called volatility, and perhaps there are other risk measures that they use. Volatility is just a measure of risk. It's not the risk itself. And if you think about it, if you own a business, all businesses are portfolios of assets. They're just real assets, but still a portfolio of assets. And those assets will produce streams of revenue, streams of cash flow. There are input costs associated with running a business. All of these things have inherent risk. So there is risk to the business. And how do we know that something is risky? Well, you have to measure it. So if you're measuring your volatility of revenues, you would recognize that, well, that adds an element of risk to our bottom line. How do we reduce the volatility of our revenues? Well, we can diversify our revenue streams, diversify geographically, diversify by introducing multiple different revenue streams or different revenue streams, different products. Maybe have tiered pricing, subscription pricing, which adds to the stability of your revenue. Subscription pricing is like a dividend in a portfolio that has financial assets, right? If you view your portfolio as a business, well, you're paying attention to the volatility of your capital, the volatility of your returns. It's just another measure of risk. Buffett and Munger don't, when they say that they don't measure risk, they don't measure risk because they've hired managers to manage the risk of their businesses. Now, if they ran all of that themselves, they'd be running risk management all day long. So it's not quite true that they don't pay attention to that. They do pay attention to it because they've hired people, good management, that does pay attention to it so that they don't have to, but that doesn't eliminate it. Second question. My question is psychology, mindset based, and I'm a big follower of Buffett and Munger, more of the latter than the former, and try to apply their teachings in life. One big difference in what you share here and what they say is that they don't follow the macro at all. Yeah, but their managers do. They own all of those different companies. I'm telling you, their managers watch the macro so that they don't have to. To just simply turn your mind off to it doesn't work. So transitively, they are watching macro. They're not, but their managers are. So in essence, they have eyes on it because their managers have eyes on it. Buffett has even stated that even if Greenspan told him his policy 2 years in advance, it wouldn't change a thing he would do based on that, but it would change company management action. And they have done significantly well over time because they invest in good management that do that. So it's not, the message to take away here is not, hey, they don't pay attention to it, so I shouldn't pay attention to it. If you're running your portfolio as a business, and it is a collection of assets, they just happen to be financial assets, and you don't have management running your financial assets, you haven't bought a management team to run your financial assets, then you got to do what management does, which is manage the volatility of your revenues, manage the volatility of your costs. You have to be concerned about the macro. You have to project where your revenues are going to come from. Do we have a recession on the horizon? Shall I shore up my balance sheet? You got to do all that because, well, their companies are doing all that. How much better can one do by what you teach us using complex calculations and high frequency of trading than what Munger and Buffett do? Well, they're not complex calculations. If you have the right broker, all of these calculations are provided to you, and you really should be able to interpret these calculations. If you have been through the 3 levels of CFA, you are introduced to a lot of quantitative methods, and you do have to do some calculation in the CFA program to get an understanding of it. But the exam over the years has been moving more and more towards the conceptual interpretation of that as opposed to the applied quantitative application of it, where you're given something and it's more about interpreting what's going on. So yeah, the calculations behind some of the measures at the portfolio level that you look at may be complex, but they're done for you. You just have to interpret them and be able to use them. As far as high frequency, my underlyings I'll hold for years, but I will use the options to continually manage my risk, much like a company will buy assets for years. However, they do manage the risk of those assets on a continual basis. It's not a matter of buy once and forget it. They do have operating income that happens over a course of time, and they do have risk management associated with the top line revenues and expenses. So if you are running a portfolio, which is a business, you then have to do all of the things that Buffett and Munger claim they do not do because management does it for them. Okay, next 3 all deal with the yield curve. Any thoughts on why 10-year yield and Fed funds rates did not move much after Friday's speech? I think you mean the Fed funds futures, or the implied rate in the Fed funds futures. And September wouldn't have moved a lot. It's October that we want to look at because the futures price is an index determined by the 30-day the Fed funds rate, or the expected Fed funds rate for the 30 days prior, which means there's a weighting per day in there. So we want to look at the futures contract after the meeting that would reflect where the futures period reflects the increase. So if you have, let's say, a period of time that the futures is measuring, and on the very last day is the meeting, and you think there'll be an increase, well, the implied rate will be affected by the fact that you have 29 days at one rate and only 1 day at another one. So if you look at the month past it, you get a cleaner read. So we'll look at a chart of that in a few seconds. I'm extremely late to the party on this question, but appreciate anyone who can answer. What is the methodology calculation for the rate increase probabilities? For the next meeting for September, the CME does it for you. There's a FedWatch tool that you can look at. And it is based, you'd have to look at the daily, what the daily move in the prices are. It takes care of all of that for you. If you go to the October contract, we can see that it's at 97 right now. So what we can do is say, well, what was the most likely rate move based on where it is right now? This is an index, so it's 100 minus R, R being the implied rate. Since it's at 97, it implies a Fed funds rate of 3%. Take the midpoint of where we are now, which is 2.25 to 2.5, so subtract out 2.375, and you divide it by 75. There's an 83% probability that's where the funds rate will be. If you divide it by 50, you get 125%. The ratio of the two probabilities is 40-60. So basically 60% on the 50, 40% on the 75, which is kind of where we are now, 68 and 31, but this is for September. This is a different period. But if you're just looking at the probability of a specific move for a given Fed meeting, the Fed Watch tool does it for you. Just pay attention to that. I'll show you where it is in a second. Let's see. Two questions. What are your thoughts on trading 2-year, 10-year interest rate spreads directly using futures instead of ETFs? ETFs don't expire. Futures do, so you got to pick an expiration date. If you go back to February 2000, December 2000, the yield curve was inverted for 10 months. We've been inverted now for, I think, 2 months. So pick a date on the expiration of your futures. So the thing with futures is you have to be right on two things. You have to be right on direction of whatever you're betting on, and you have to be right in a particular time frame. That makes them challenging unless you roll them over, or you continually roll them over until you're right. But it depends on the shape of the curves and what you're rolling over and what it costs you to roll over. So you can look at it, but you're going to have to choose an expiration date. Second question, with the Fed being emphatic on the direction of short-term rates, any thoughts on selling calls on futures given that rates will continue to rise? Well, I don't know that we can say that rates will continue to rise, especially capital market rates. They may not. The yield curve just may become more and more inverted, and those rates may not rise. What we can say is that maybe they don't continue to rise. I think it's a safer bet to say they probably won't drop. So I don't see rates dropping, but I can't say that rates will continue to rise. It just seems to me to be a safer bet to say I can't see with the Fed moving the short end of the curve up, unless we're going for significant inversion and the capital market participants simply don't believe the Fed or believe that inflation is going away. The economy is going to be in a position where the Fed will then be able to say, okay, job done. So instead of saying the Fed's going to pivot because the economy will be weak, the new language might be, oh no, the Fed won't pivot because the economy is weak. The Fed will pivot because the job is done and the economy is weak. I don't know. Any direction that you're thinking of taking, they're never easy directions. You're never going to find low-hanging fruit. Sometimes some decisions are easy to make. Other times they're more difficult. So doing something like this, selling calls, I would think, okay, your story could be that rates are going to continue to rise, or at least they won't drop. Then if that is your story, if that is your belief, then selling calls is probably something that would make sense. Okay, let's look at the Fed funds futures. Okay, the August contract is now gone. It wouldn't have changed because there was no Fed meeting in that period of time. If we look at the September contract, that's not going to help us very much. We have to look at the October contract. So if you click on these little dots right here, we should get a chart up. It just opened in another window. Let's expand this a little bit. And I know it is kind of hard to read, but if you look at the volume 412 today, that's not a lot, right? Let's go down to 4 hours here, so we can capture this red one in here. If you can see this red bar in here, there is 9 a.m., which is 10 a.m. based on when Powell gave the speech, just different time zones, right? Because this is Chicago, he was in Wyoming, we're in the New York time zone, so there's the right time. So you can see there was some reaction, and this coming down is the implied Fed funds rate going up because the rate is 100 minus R being the rate. So the lower this goes, it implies a higher Fed funds rate. But 50 was pretty much already in there. There was pretty much guaranteed that we were going to see 50 in September. This is showing that no, now they're starting to move closer to 75. Not all the way to 75, but that 75 now really is a possibility. So it is moving. It's just that this is not going to move a lot. Like a small move, 8-9 basis points. That's a big move in Fed funds futures. So it did respond. The 10-year and the 2-year didn't respond that much. Let's have a look at that. Okay, for Treasury rates, for capital market rates, just go to treasury.gov. You can click on data, and the very first one here under interest rates, you have the par yield curve rates. And I have it here for all of 22. You can shorten it. You can just say the current month. Actually, we'll just click on current month, apply. We don't need to go all the way back to the beginning. And let's see where we are here. 0826, this row here was the date of his speech, and you can see this is the 304. There's your 10-year. The day before was 303, so not much of a move. And the sixth one in over here is the 2-year. The day before was 335, 337. But if you go back 2 weeks, and this is the 26th, go back to the 19th and then the 12th, and have a look across here. You can see the 10-year was at 284, and now it's at 304, so those are 20 basis point move. Considering that for a long period of time, if you follow this back, it was under 2.8 for quite some time. That it, breaking out over 3 is significant, and it's continuing, right? You got the 311, 304, 312, or 311. 6 1 in, 1 2 3 4 5 6. This was 325. The 2-year ended Friday at 337, 12 basis points higher. It's a 2-year, so it's not going to be that much out of line with where we think the Fed funds rate might go. With about usually 40 basis points is the average spread. So we're at 2.5 right now. The 2-year is at 3.46 right now. So if you take off 40 basis points, that's 306, which is pricing in, not really pricing in, but it's sort of anticipating maybe 55 basis points is where the Fed funds should jump to, because usually you have about a 40 basis point difference between them and the 2-year leads. So 3.46. So it has been moving up. Bond market is a little bit smarter than the equity market. We say it's smarter is because there's less opportunity, and I don't even want to use the word opportunity. There's less process in the background to create these rates. It really is more about supply and demand. So when we say the bond market is smarter, it's only that it's cleaner in its intentions. The equity market is not cleaner in its intentions. Sometimes there's process going on in the background that moves the market, but it's that process that is necessary to create the liquidity in the market, but it ends up creating a market that doesn't reflect reality sometimes. So, keeping your eye on the bond market, when the bond market is moving in a particular direction and the equity market is disagreeing, have a look at the calendar and ask, is there an options expiration date coming up? And if there is, well, that could create a whole bunch of distortion. So as far as the bond market not moving, it didn't move on that day because the bond market anticipated that the Fed's not going to pivot. It's not going to pivot, and it's been telling that story for 2 weeks. Ever since the Fed speakers have been coming out, the bond market has been telling that story, and the equity market, if you don't look below the surface, the equity market seemed to be saying, we don't believe you, and something was at odds. One of those two markets were wrong. It's typically the equity market. When the bond market is saying something and the equity market's saying something else, it's typically the equity market that is wrong. All right, next question. Is there a way to effectively execute this strategy? This is the DDB. Through non-margin positions, that is simply buying into equity SC to increase DDB so you can keep short. Or do you have to match leverage with leverage? Well, if you're in a non-margin position, I'm not sure how you can be short, but we'll just take it as it's written. I ask this because many smaller account investors can't afford the downside of short straddles, so the only option for positive DDB exposure is long equity or calls potentially. So there are securities which have positive delta, which is most long positions and options, and there are positions which have negative delta. There are also securities which will package negative delta into a long delta for you. So if you look at short ETFs, and don't use the leveraged ones, don't use 2, 3, 4 times, just use single leverage. SH is the short version of SPY. It is 1 times SPY. So SPY was down 1.1% today. SH was up 1.17%. SH is, I think, 15, 16 bucks. It's a very low cost security. So you can always add a long position which has embedded within it negative dollar beta. So you don't have to actually go and get dollar beta and worry about margin. You can actually take a long position in a security that has within it negative dollar beta. So there are lots of different securities that come packaged with negative risk in it, as opposed to having positive risk exposure. You have negative. So you can do that. Or you can simply say, look, I have a certain beta exposure, certain market exposure. I'd like to lower it. This is where you cycle out of small cap stocks into large cap stocks, out of growth into value, which means you're moving towards, if you're small cap growth and you're moving to large cap value, you're moving from high beta stocks to lower beta stocks. So just select lower beta stocks or sectors. And this is just a rotation that larger portfolio managers will do. Is they'll raise the size of the company, divest of some small cap stocks, move up to larger cap stocks, move from growth into value, so that it lowers the amount of beta they have, because they can't be short, they can only be long. So a way to bring your dollar beta towards zero is just to select the types of securities that you want that would have lower beta. Open question for someone who is working and without so much experience. Would you recommend just hold the index? Well, I would say yeah. I wouldn't try any kind of stock picking or anything like that if that's all you're doing. I'd say get somebody to do this for you. But if you're doing it through a fund or an ETF, that's the best way to get diversification. I think if you have an equity exposure and you're investing over time, and let's say every quarter you're going to invest and you're going to buy the index wherever it happens to be, the index has a bias in the long run to go up. So there will be periods of time where your investment is not going to go up. It may go sideways, it may go down, but if you're investing for the long term, yeah, you're getting diversification in large cap companies. The SPY that you're buying has a very low management fee, lower than other mutual funds you're going to get. You get a dividend yield where you get paid quarterly, so you can reinvest those dividends over time, and the index itself rebalances. Companies that don't meet the criteria anymore are kicked out, and new companies that come in, so you never have to worry about stock picking or rebalancing. Let's see, or wait for a possible entry point later in the year. Well, now you're market timing. So if you don't have so much experience and you suddenly want to start market timing, that makes it kind of rough. I understand this means market timing, but the narrative will probably turn bearish in the next few days. So you can start with SPY, or you can start with something like XLP. XLP has a dividend of about 0.5 to 0.6, really, really low. It's the ETF for consumer staples. Dividend yield of 2.7, which is about 110 basis points above where SPY is right now. I think at least 100 basis points higher. So instead of 1.7, you're getting 2.7. And this is a growing dividend. Every year that dividend grows. If the market goes up, this will go up. It still has a positive beta, but if the market goes down, it doesn't really go down that much. So if you're concerned over a couple of quarters of negative returns, possibly sitting in XLP will put you in a better position in terms of downside risk with a better cash flow. Let's see, I'm wondering exactly how you accomplish a delta neutral setup. That was a perfect detail I needed. How do you think about taxes? I think about it a lot when it comes to making these trades versus long-term buy and hold. Nowhere in anything I said am I not a long-term buy and hold investor. I am. Some things I will own for years and years. I have no problem with very long-term holding periods. I'm not a day trader. I don't jump in and jump out. I use options to engineer my entry and engineer my exit because I want lower prices than what the market is getting. And while I'm holding the underlying, I'll use options, and I don't get greedy. I use options in a very judicious way to generate more income on the securities that I hold. Sometimes they'll get called away. That's just the cost of doing that kind of investing. And sometimes they're put to me, and I'm comfortable with them being put to me if I'm selling puts. But for the most part, those are sort of income generators. They're not. They're capital gains, or they become embedded in my own capital gains. So, for example, let's say that I'm long 1,000 shares of TD Bank, let's say. Or better still, let's use Bank of Nova Scotia because it's under pressure. It has a nice dividend, but I don't see it going up for a while. And I want to match the dividend on this, so I want to double my dividend. I'll sell calls, 10 calls on BNS. And at a price that's not greedy, at a price where I'm going to add some cash flow to my portfolio, and I'm really just trying to match the dividend. I'm not trying to protect myself from every single price move down. Get that out of your head. You're not going to do that. And if you're worried about losing a single penny, then don't do it. Buy GIC. But when you buy something, there are times where, guess what? Over a period of a couple of months, almost everything you have will have red ink. That's going to happen every 6-7 years. That's going to happen for 6, 7, 8, 9, 10 months at a time. And you just have to say, well, this is just what we're going through. So I don't use it to try to protect every dollar on the downside. But I will use the calls to generate extra income in such a way that I feel very confident that I'm not going to be called. So I'll use like 16 delta calls, and I'll use a front month contract. I let them expire. I don't close them out. I let them expire. And when I let them expire, what happens over here is it says, okay, well, that's a covered call. So if your average cost was $70, and let's say I sold these for 60 cents, then as far as Revenue Canada is concerned, my average cost is now $69.40. It embeds itself into my capital gain on my underlying. If I close them, then it does not do this. However, it considers all options as capital gains. So it's still just a capital gain. If they were declared as income, then I would probably pick different expiration dates. If it gave me a better tax treatment. But the way I use them, I kind of play a game with myself month after month. Is for certain stocks that I have that have options, I try to see how low I can get the cost of my stock. And I keep doing that, and I keep embedding the capital gain into that basis. So I don't, it may look like I'm doing a lot of work, but that's all income generation and risk management. The underlyings I do hold for, quite some time. I don't swing trade. I don't day trade. Now, when I say I don't day trade, if I go into something and it suddenly moves like nothing else over the course of a day, and I look at it, I go, well, that's a ridiculous move. Clearly, I got lucky. That's a ridiculous move. Yeah, if a day trade makes sense, I'll take it, but I never start off by thinking I'm going to day trade. I may do it with currencies if I think that there's a reason why a currency in my portfolio is going to be weak. I might do a spot trade just for the day. and just protect something, I might. I used to be more willing to do that years ago. I'm less willing to do it now because it's hard to do at scale. If you have a $10,000, $15,000 portfolio, little spot trades here and there can actually help. But they don't move the needle where I am, and it's very hard to do it at scale, and it's very risky to do it at scale. So some of those strategies that you'd use in a smaller portfolio become either a nuisance or not profitable or not worth it at scale. Okay, these next two questions are somewhat related, and we have to keep in mind that any statistic that we calculate is an estimate. We're not looking for decimal place precision in what we're doing. We're looking for general direction. First one, can you show us how you manage your liquidity and margin? And I have IB's Risk Manager open all the time, so I can see at a glance where I'm sitting. So I know that I can see where it's moving to. If I have an issue where I might fall below the 10% margin, which IB then beeps at me and highlights it in a yellow bar to make it really noticeable to me, and will continue to beep it at me, then I can start to fix it. I could step in and start to fix things. Sometimes just taking offsetting options positions can fix a lot. So if you are short a whole bunch of options, let's say that I sell on SPY, I think that the market is going down, and I think, well, that's as low as it goes, so I'm going to sell some 360 puts, and it breaches that and it keeps on going. Well, my margin requirements are going to increase every day. I can go all the way down to 280 puts, really cheap puts, and I can go long 280 puts, and I will increase my margin instantly by doing something like that. So there are things that I can do in that respect. As I move closer to options expiration, well, it's a job, right? You have to look at it. Some of your options you can look at and say, well, these are going to be assigned. What's my cash positions? And maybe I don't want some of them assigned. Maybe I'll look at a couple and say, well, let me roll these. And so I might roll them forward to the next expiration date. Well, that doesn't affect me. I won't have any cash outflow for assignment. Some will expire worthless. I can just ignore those. And some I will accept assignment on. So if they expire worthless, let them expire. If they're going to be assigned, I make an assessment of whether or not I want to roll them or whether I want to accept them. And how do you invest between registered and non-registered accounts? For registered, long only, low beta, dividend payers, primarily REITs, because there is no tax benefit to earning REIT dividend income, because the REIT doesn't pay tax, so you don't get a tax benefit. You pay all the tax, so you may as well earn them in accounts in which you can either defer the tax or just avoid the tax, like a tax-free account. But long only, low beta, and they got to be dividend payers because they have to generate cash within that account. I'm not looking for capital gains in there because I can suffer capital losses. Things with dividend yields usually I get supported in price in the market, and if you're looking at good quality REITs that pay a regular dividend, that reinvestment every month when you get those dividends, because Canadian REITs pay every month on the 15th. You get those dividends on the 15th and you buy more shares of something else. That reinvestment over long periods of time, that compounding and the compounding of the dividend, even if your underlyings really don't go up that much, just the building of the number of shares you have by reinvesting is extremely powerful. Next question. I see you are using the last 2-year daily returns for your beta. Since beta is a past measure, I was reading a research article that said, indeed, beta has shown inconsistency over the long run. Well, you have to break beta down, right? Beta is really a correlation multiplied by a ratio of volatilities. So when we say that betas show inconsistency over time, we want to know, well, what is exactly showing inconsistency over time? Is it the correlation that's showing inconsistency, or is it the ratio of the volatilities? These tend to be stable over time. Especially for mature companies, they tend to be stable. For growing companies that have very high betas, as they grow, those betas tend to drift towards 1. And in times of crisis, even low betas tend to increase. And, it really depends on what it is that you're holding. Some securities that have low beta are known for having low beta, and in times of crisis, their betas increase because money flows in and their prices actually increase while the market is going down. So you actually end up with a negative correlation. So when we say that betas are inconsistent over time, do we mean correlations are inconsistent over time, or the ratios of the volatilities are inconsistent? If you have a mature large cap value company, this tends to be fairly stable, so it must mean your correlation changes. But yeah, they do. And let's say that you have a stock with a beta of 0.8. This typically would mean that you have that kind of sensitivity to the market. So if the market is up 1%, the component of your stock that has that sensitivity should be up 0.8%. But this is 0.8% over a period of time. It's a big broad average. It doesn't mean every single day you're going to get exactly that. It's just over a period of time. It's the best estimate that we have. You're not going to, as I said earlier, calculate something to 2 decimal places and say, aha, we're good. I guess your beta metric is applied for all stocks with that single setting and not choose what time period and return frequency to use for each stock. Well, every stock uses the same. It's based on 2 years daily. That's how everyone is calculated. Mostly beta will approximately hold up for most stocks. Yeah, if you depending on where you are, if you like playing in high duration small tech IT, where all the they have a market cap of 300 billion but do no more business than the corner store down the street, and they just have this big story about all the cash flows in the futures, well, that's going to be a wild ride. They may not hold up very well at all, correlations or volatilities. And since it's rolling two-year period, yeah, so rolling means, it's 2 years, and then the very next day, the last day falls off, and the next day is added in the 2-year period. So you always have a recency bias in your beta. Some stocks can perform wildly different than previous comparable business cycle period too. Yes, they can. So here is how you measure the success of what you have. And again, you're not going to get precision to multiple decimal places. Let's just assume we have no options in our portfolio. You're really just looking at dollar beta. That's all it is. So I'll have dollar beta of a certain amount. And I may have this idea that I think that we're in for a period of weakness. I think the current narrative is dead, and because it's dead, I think some of this retail crowd is going to go away. I think we're going down for a while. I would like to lower my dollar beta. Again, it's not a perfect science, right? And I might say, well, let's lower it 20%. At least knowing my dollar beta, I can multiply that by 0.2. And then I can go to the SPY options and I can look at different deltas, and then I can determine how many options I need to sell to get that down roughly 20%. The important thing is I'm moving in the right direction, down, by what I feel is a good enough estimate, 20%. Otherwise, I wouldn't know what I would do, because you have all these positions. Well, what is 20%? If you didn't know how to measure the combined portfolio risk as best you could, it would be hard to come up with 20%. Now this 20 is not exact, but I do know that in doing this, I have lowered the risk that I have. So if there is a sell-off day, it's not going to be as bad as it was. Let's say I get dollar beta neutral. I get as close to zero as I can. Well, as soon as prices start moving, this is going to start moving one way or another. It's not going to stay at zero. It's going to move one way or another. So these are not set once and forget it kind of hedges. You have to continually manage the hedge. So if it's moving out of alignment over the course of the day, you can look at your positions I can calculate, this is the beautiful thing about this risk navigator, is I can calculate my dollar delta beta of the portfolio, eliminating one position at a time. And I can isolate the one position that's causing me grief. And then I can do individual risk management with that, because you have precision to do 2 decimal places at that point. So if you have ABC and you're long ABC, and for some reason it's the one that's causing you grief, causing the volatility in your capital, because you think that you're at zero, but you're not, because you keep losing. You look at your screen, you see, well, not this number. You're looking at your profit and loss for the day, and you see it's negative, negative, negative. You think, okay, well, something is wrong. You isolate it to ABC. You can go to ABC and say, okay, well, I'm going to deal with you directly. Any options on this has a correlation of -1 with the underlying, because it is the negative underlying. It is so many shares of the negative underlying. So then you can actually get very precise and not worry about beta at all on that one, because the option will have the exact same beta as the stock. Even if you don't know how to measure that beta or what the best measure for it is, you can isolate that one that's causing you grief and hedge that one out. But if you you'd only do it if you're losing. If you're gaining, then you also would look at your position and say, well, which one's the winner here? Which one do I like, and why is this one behaving so positively today, and is this something I want more of? So it's just you need some measure. You need something, because you can't just throw your arms up and say, oh, it's all too complicated. But what you don't want to get married to is this idea of absolute precision. It's what I call a neighborhood. I want to be in the neighborhood of this. Or if this is the neighborhood I'm in now, let me move to a different neighborhood by lowering it or by increasing it. I don't know what house I'm going to be in that neighborhood, but I'd like to move to that neighborhood for a while. That's all it is. So if you think about it that way, everything forward looking is estimates. It's just one big pile of estimates. All right, 3 questions here. The first one, not so much a question that leads itself to an answer, more of a discussion, and it could be a long discussion. The short answer is on both of them, I don't know. But let's read it. After last Friday's sell-off, it seems like the market has finally realized the Fed is not going to pivot anytime soon. Most of the market, because I am still hearing the Fed is going to pivot, they're going to have to. Because the belief, at least the thesis being put out now, is that inflation is going to disappear before the end of the year. It's going to disappear faster than what the Fed thinks, and that's going to be a good thing for the Fed. The economy is going to crater faster than what they think, so their job on inflation will be done. Their second mandate is full employment. They'll see that cratering, and they will pivot. So it's not the Fed's going to pivot. It's the Fed's going to pivot, they're going to have to. So that's the new one now. We'll see if that one gains any traction. Honestly, quite astounding that the Fed is going to pivot narrative was so prevalent. I thought so too. This idea, as much as they kept saying, no, we're not, no, we're not, no, we're not. It was the whole market go, we don't believe you. It just seemed to me so ridiculous. You're willing to take the Fed at its word when it says we're going to keep rates low for an extended period of time, but you simply won't believe them when they say we're going to raise rates and keep them there for an extended period of time. You think, no, suddenly now you're all lying to us. I don't know. I agree that it's quite astounding that anyone would buy into the Fed is going to pivot based purely on not believing them, Big banks such as JP Morgan were putting out price targets of 4,800 on SPY. They weren't the only ones at 48. What do you think of their claims that a global recession is not expected? A lot of bearishness has been priced in. What would be your current year-end target for SPY? I don't have a current year-end target, only because we are so data point dependent. September only has 3 trading days. It has Jobs Day, CPI Day, and the Fed Day. All the other days are just noise. It's just a bunch of people milling around in the lobby going, I don't know, what do you want to do? I don't know, why don't we go over here? What do you want to do? waiting for the movie theater to open up. There's only 3 days in September. It's hard to have a target on year end when you have no trend. When you can draw a straight line of whatever's going on. You could draw a straight line to the next report, and it's either going to confirm or disconfirm what's going on, and you might be on a different line. So the pricing in the market is what mathematicians would call non-differentiable. Because you don't have these smooth price patterns anymore. It's these sharp turnarounds and these bear rallies, these bear market rallies that 100 points up in a day, and sometimes you get sell-offs 100 points in it. Well, hard to figure out where we're going with that. So I don't have a year-end target on SPY. I have a thought about I'd like to be as neutral as I can until I have clarity. That's all. As far as these price targets, when you see some price action that seems to be going on for quite some time, it tends to bias your opinion. So there's it's like a chicken and egg, right? Does the narrative cause the price action, or does the price action create the narrative? So you have 3,600, and then we rally to 3,900 on what most agreed was short covering, and then the narrative showed up. The Fed is going to pivot. The Fed is going to pivot. We went from everyone's extremely negative, we're due for a bounce, we get a bounce, this is a short covering rally. Once you get past 200 points up, 250 points, it then became the narrative. So you had the price action, which then drove the narrative, but then the narrative started to drive the price action. And then you went another 250 points. Well, you went from 3650 to 4250, 600 points in 6 weeks. It's hard not to be swept up in that, and suddenly it starts getting into your head. And as an analyst, sometimes it's hard to say, what, all you people are wrong, and you're going to suffer. And sometimes it's easier, if the trend is doing this, well, just project out. There's where we're going to end. And keep in mind, whenever they do that, that is the middle of a distribution, right? That is the middle of a distribution. So if we end lower, they'll say, well, that is within the distribution that we had. 4,800, 95% confidence interval. It might be 3,200 to 5,800, right? And okay, all they're doing with that target is giving you the middle of a distribution, so that they can say, well, we said it would end within this 95% range. So you have to read their report. Read their report. What are the assumptions that it's based on? Because it may be based on some key assumptions where they, it's kind of like your get out of jail free cards. It's like, we'll get to 4,800 if 1, 2, and 3 happen. That's where we'll go. Well, if 1, 2, and 3 happen, right? If not, well then all bets are off. And when they give you this target, they may give you a range. And that range may be so wide as to say, oh, wow, come on. I never, even at 42.50 when the rally was still going on, I think we got to 430 on the SPYs. I still never thought that it was real. And 4,800, I kept thinking, are you some kind of idiot? I think there's one guy on YouTube from CNBC, I don't know, the clips on there screaming 4,800. I thought, what kind of idiot are you? Anyways. Thank you for another great video. I just have a quick question about risk management. I've been using IBKR's SPX Delta and calculated as delta times dollar adjusted beta. Yep, that's fine to manage my portfolio risk. It basically tells you how many units of the index that you're long. It's just another measure. DDB had any significant advantages? It has an advantage for me because I can say, I can look at this number and I can say I want to reduce that 20%. And from that 20%, I can get, a dollar beta out of it, knowing that the SPY has a beta of 1. I have a dollar value that I want to decrease that by, so some dollar value. And then from that, I can then easily figure out how many options I need to sell or buy. If you're using SPX, it just basically gives you an indication of how many deltas you're long on SPX. that make it easier for you to hedge out using futures on the index. Whether you're using SES or SPX, you can, ES is 1/5 of what SPX is. It just makes it easier for you. Because I don't like to use the futures, I prefer the options. I prefer DDB over SPX Delta, but they're the same thing. It just, whatever makes it easier for you to think. Now I could use SPX Delta and I could just get my calculator, I'll do some quick math and come to the same answer. Or I can use DDB and I can do it in my head rather easily. So, it's whatever you're comfortable with. Because I use options almost predominantly for risk management. I don't think I used the futures contracts for quite some time. That DDB to me just is an easier step calculation-wise. Let's see, how to handle the situation when you're making DDB positions going into 2021. That's a long way back, and you think by adding a long TLT position that will offset your net long equity. Adding a long TLT will offset my net long equity. I'm assuming that you wrote it correctly. And that you're assuming that the bond position will act as a negative correlate on my equity position. I guess the question I have is, how do you know the betas will hold? Well, you don't. It's the best measure that we have. Anything forward looking is an estimate. You don't know if that's going to hold, but you got to have something. So think about it as here you are. Hi, standing there. And you're interested in going a certain direction. Sometimes it's better to know that you're heading this way as opposed to knowing that you're heading right there. It's at least knowing this way so you can say all of this, at least I'm not going that way, but I need to be in here. So unless your estimate is really, really off, you'll end up in some future range. And that's the way I think about estimates is, they're pretty good at saying, hey, where's the local bar? And somebody says, oh, it's down that way, without telling you where. At least you're going to start walking in the right direction if you still don't know where you're going. And then you can ask somebody else as you get closer to get a better measure of where you need to be. I thought that they do this. I thought that they do until this don't, and they seem to break even when you need them to hold the most. Isn't that always the case? I believe this is the issue of modern portfolio theory. The negative correlation between treasuries and equities broke down a long time ago. After GFC 2009 onwards, it was a positive correlation. So that negative correlation broke down. So the 60-40 portfolio worked when the market was going up because both equities and bonds went up. But when rates started to rise, well, then that hurt equities, which hurt bonds. They still have this positive correlation. They haven't flipped into a negative correlation yet. There probably was no safe place to hide unless you created a security that had a negative correlation, which is options. Okay, this is actually a good question because it is it's more operational. Using your example on HXB, I'm curious to hear how you would manage large drops. If HXB were to drop 10 or 15%, you wouldn't get much premium from your calls. If you were aiming to have a strike price close to your ACB, no, you would not. In a case like this, would you sell calls above your ACB or wait and hold? I'd be curious to hear your thoughts on both a theoretical scenario where you have developed your full position, but also in the current scenario where you're still deploying your position, which would enable you to lower your ACB, but still might not enable you to get decent premiums. So I sold the 62s for a quarter position, and if they are put to me, they'll be put to me because of the price I sold at 58. I'll have an average cost of 60, roughly. I'm just coming up with round numbers, so I don't got to do a lot of math. Let's say it falls to 52. So you have a choice to make. Now HXB is paying me a dividend. I get paid to wait, and I'm taking HXB because fundamentally even after we get past this, we haven't solved the housing problem in the U.S. There's still a shortage of housing. And if you solve the supply constraints, if that just solves itself, well, then the home builders are in great shape. If the labor market can solve itself, the home builders are in great shape. If not, well, they're still going to have to build homes, but they're going to be more expensive, and there's still going to be a demand for homes. There's got to be a fundamental reason for me to want to build a position in this now to hold long term. And just because I buy something doesn't mean it's going to stay positive. It can go negative. So number one, I have the dividend yield. I can live with that. I'm comfortable at 62. So if it drops to 52, I probably would say, well, this is a great opportunity to add another quarter position. I would do a straddle at 52. Again, I'd be short the put, and I'd be short the call. And if it increases on me, well, then this would be called away. And if it drops, well, then I would get a lower price. So I'd be looking for my next quarter position. So I'd still work my position at that lower price. A lot of it also depends on, well, what got us to 52? And is that over? So there could be some news that got us to 62 where I say, whoa, okay, I'm going to hold off for a while. I'll keep what I have. It's half the position I normally would have. I'm going to hold off for a while. And this position here, I can always hedge out again because I keep my eye on dollar, delta, beta. And if I say, well, I am not going to take any loss on this because I plan to hold it for the dividend. And again, fundamentally, the market's going to come around, but I can earn income somewhere else to cover this. You don't, as a general rule in the market, you don't have to make money the same way you lose money. Okay. How would I sell calls on this? Well, if we draw out a timeline, the further out I go, let's say that we're at 52. We'll just draw this across, and I'm looking at the 60 premiums. The further out you go in time, the premiums do start adding up. So you might have to go out 6 months before you find 50 cents or 60 cents on the $60 calls. It's still more than nothing. The shorter the time period, the less the probability this is going to increase. So I may say, well, I feel safe with a 16 delta call, knowing that if it rises above that, some of this position may be called away. Okay, well, I'd be underwater if it gets called away. I'd take a loss if it gets called away, but I'm underwater anyways. Maybe, again, it depends on what got us to 52, what the fundamentals look like. Is this a trend or is this an event? I don't know. If I felt that, well, no, we're down for a while, then yeah, I'd sell calls below my average cost base. I'd sell 16 delta calls. And if they weren't exercised, it would lower my average cost base. So then, if I got $1 for this and it was 45-day calls and 45 days later it doesn't breach 60, well then my new price is now 59, and on the next round I can go out. Maybe this is now 54 and the 59s have premium. Or maybe it's 42 and 59s don't make a lot of sense, then I'll keep selling 16 delta calls. In case you're wondering, why would you sell a 16 delta call? What's so special about 16 delta? Let's say here's the stock price. Here's 45 days, and you calculate out the forward price of the stock. And the forward price of the stock is just the spot price multiplied by 1 plus R to the T being expressed in years, so it'd be 45 over 365. This is the middle of a distribution of where the stock could possibly end. That's all the forward price is the middle of a distribution. And this is the underlying distribution of the stock. Options usually have a wider distribution because the implied volatility of options tends to be greater than the actual volatility of the underlying. So on this distribution, on the blue distribution, Remember, one standard deviation covers 68% of the distribution, right? Which means these two must add up to 32%. So you got 16% up here. There's your 16 delta call. On the wider distribution, which is on a gamma basis, which is this actual distribution, is actually a lower probability than what the implied volatility would say. So you play the odds. And if you're doing this, if this is part of what you do year after year after year, you may lose like 10% of the time, because this 16 distribution might be 10 on the actual distribution. You might lose 10% of the time, but win 90% of the time. Well, the odds are in my favor at that point, right? I hope that answered your question. By the way, if you need to know more about doing this kind of stuff, the applied series in the options course, this is what we do. This is what you will learn how to do, is what I just showed you here, combined with a whole bunch of different strategies. So if this is appealing to you and you want to know more about this kind of stuff, that's exactly what we do in the options course. We go into detail on each strategy about, what part of the distribution are we playing. Okay, why do you prefer index option trading, SPY versus VOO? These are not index options, this is ETF options, but I get what you're saying. Since VOO has lower expense ratio, does VOO have less liquid options, or is another reason? Two reasons why I like SPY. SPY is structured so that on a very quick basis, it is 1/10 the index. You can look at the price of SPY and you have a very good idea of where the index is. VOO, you don't. It doesn't have that relationship. Also, look at the volume. This is today. Look at the volume. I'll do a better color here. Here's the volume of calls and puts. Look at the volume here. Look at the difference. These are in the thousands. Let's just take a strike price here, 370. You can't take the same strike price because they're different prices, but you take the 370, you got 10 to 1010, fairly liquid. But if you go off 365, this blue line here, this is the at the money line. So 370 is sort of the most liquid option. You're going to get 10 to 1010, but then you got 750 to 8. You got a 50-cent spread. And if you go from 370 to 375, notice they're $5 increments. 1280 to 1360, very wide spread. The put on this one, 540 to 580. Sorry, the call on this one, these were the puts. Sorry, these are puts, these are calls. The call on this one, 540 to 580. Now let's go over here. Notice that it's every dollar, so you have a lot more flexibility than where you want to be. Let's take the 397, 860 to 862, 2-cent spread. Head on over here, 904 to 906, 2-cent spread. Far more liquid, much tighter spreads. When I say liquid, look at the volume versus look at the volume here. A lot of liquidity here. Even if they were tight spreads, because there's no volume, if I actually want to get out, who's gonna help me out? If I want to come in with volume, let's say I wanted to do 400 puts, how can that be absorbed? There's no one there to get it done. But with SPY, I don't have any issue about moving the price of the option, even if I want to do 400 options, which I've done in the past, 400, 500. I've done as many as 800 options at one time. And with SPY, I won't move the price. And if I have to cross the spread, I'm crossing 3 cents or 2 cents or 4 cents at most if I have to cross the spread. Far more liquid. Tighter bid-ask spreads, and a better relationship with the index. That's why I use SPY. Now, when we're saying that it has a lower expense ratio, that is if you're holding the underlying. I don't often hold the underlying on SPY. I use options on SPY to manage the risk of all the positions I have, as opposed to trying to manage risk at each and every single position level. I just use it to manage risk at the portfolio level, and because I'm using the options, I don't pay that expense ratio. All right, 3 questions here that I think I can answer rather quickly. They're not so much discussion as more yes or no. First one, quick question as it relates to your strategy or mindset when selling options for income. My understanding is that if implied volatility is higher, the premium should be higher, all else equal. That is true, meaning greater income relative to the underlying security's current price if not exercised. The question is there ever a point in your mind when IV is so low on an individual stock or ETF that it's not worth the minimal income when accounting for the risk of being called or put in a position? If so, what's your method of determining the appropriate required income to make it worth the while? Yeah, there are some securities on that I own that if the market's boring for a period of time and I think, well, let's earn some income here, let's look at the options. Some of them are just not worth doing anything on. And there may be some stocks out there that I think I wouldn't mind a position if it got down to this price and you look at the price and there's just no premium there. Then I just don't do it. As far as having something that makes it worthwhile, let's say that I'm selling a put and it's 35 cents. So you sell one, you're getting $35, but it requires $6,400 in margin. That's just not worth it. Now, if I were selling it 35 and it required 300 in margin, well, maybe I would look at that. But these kind of this kind of investment in margin to generate 35, and you're not even generating 35 because you had to pay to get them to begin with, doesn't really turn me on. So I don't know that I have a specific rule for it other than just a feel where I can look at something and say, I don't know, I don't like that risk return profile, let me look at something else. Process of selling calls on the way up, selling puts on the way down. You mentioned you looked at forward PE for something SPX, but for individual stocks, do you use some set price targets or technical analysis to decide when to stop? Yeah, I do that for the individual stocks as well. Typically, I'll be attracted to a particular sector. I think a sector will do fairly well. And if I have no opinion on stocks, I just stay at the sector level. If I am looking at individual stocks, there's always a group of stocks that are in the same industry. You can do a percentage chart on them where you pick some starting point and they all start at 0%. And then especially after we've had sell-offs, you'll get charts that look like this, where this one's down 32%, this is down 20%. Well, whatever you're looking at, take the bottom ones, get rid of. Look at the top two; they're the ones that held up the best. Right away, the market's doing a lot of work for me by letting me know which ones sold off the most or which ones had to sell off the most and which ones didn't sell off the most. Technically, that's probably about as far as I really care to go. It'll help me identify the strong ones in a peer group based on how they've performed. And then I can go from there. But, when I look at where I want to enter into, I'll have some fundamental level of where I think I'd want to be. Sometimes it's, you're looking at a chart and you're saying, well, it looks like it's been well supported at a certain level. I see nothing about the behavior of this that says it would be otherwise, so maybe that's a good place to sell something. Sometimes I'll do that, but resistance and support, that's about as far as I'll go with the technicals. I prefer fundamental levels. Last one on this screen, and then there's only one more screen. Thank you so much for putting dollar delta beta concept here. May I ask why you prefer to sell calls instead of buying puts? Well, I do this because I like the income component of it. And when I roll, it's easier to roll because let's say I sell a call at 400 and I get $4 for it, and it goes to 410. So now I'm $6 underwater. Well, if I roll it to the next month, I'm going to get at least 10. So I can always just continue to roll it. Not only that, if it's at 410, I don't mind it being called away from me. My thinking is I don't mind it being called away and giving me the position, because then I can use options to continually work that out. When I buy a put, it depreciates to zero, and then I've got to buy another put, and it depreciates to zero. I don't always just sell calls. There are many times where I will buy at the same time. So risk reversals, especially on big big sell-off days in bull markets. In bull markets, I like doing this. Big sell-off days, buy a call, sell a put, because you're going to get a very asymmetric profile on the call and the put. If I like a U.S. stock, but I don't want to put out U.S. dollars, it has a dividend. I want the dividend, but I don't want the 15% withholding, and I don't want to pay a dividend tax rate on that. I want to pay a cap gains tax rate on that. I'll do a synthetic, which is to you're going to buy a call and you're going to sell a put at the same strike price. So I do buy options depending on the strategy that I'm looking at. There are times where I will be uncertain as to the direction of something. It'll be doing this, and I'll say, well, I don't know where it's going to go, but I have a bunch of strategies that I can use, so let me start by buying a call. That's my first step. If the market goes up, yay, I win because I bought the call. If the market has more weakness behind it, well, let it go down. It'll be some point where I can sell a put, which then pays for my call, and I've stepped into a free risk reversal with a put at a lower price than I would have gotten had I put it on at the same point in time. So I'll step into position, so I'll buy, but when I'm looking at generating income and hedging at the same time, there's two birds with one stone. Selling calls, selling puts, to me, just seems like a nice, easy way to get to stay in the game and get done what I want to get done. Okay, two questions. This here is all one comment here. One thing I've always felt curious about, when the market moves so much in a day, such as last Friday, who is actually moving the money and why? Well, it's coming from all over the place. And why? Well, what they believed the night before was shown to be wrong. So the reason why they have a long position no longer exists. So some people decide it's time to de-risk as the market price starts going down. That forces some people who still have no concept about what's going on. Why is the market going down? Well, they're losing money. Usually the retail investor, they usually have weak hands, meaning they fold very quickly. So as they start losing money, they start getting worried, and then they sell, which cascades it even more. What can really cause this to continue during the day is the options market. So when he was reading his speech, there might have been a lot of put buying. So individuals and institutions buying puts on the index. And if you're wondering, how does put buying actually create selling, you have to think about who's on the other side, which is a dealer, because they have to make a market in the options. Well, if you're buying a put, that means they're selling a put. So they sold a put, which means they have positive delta. Because the put has negative delta, they sold the put, they have positive delta to hedge, they need negative delta. Well, they get negative delta from the index itself. Whether it's from the index or from the ETF, either way they hedge out by selling. So buying puts at the portfolio level, at the dealer level, will create selling in the market. So if there's huge put buying, if there's a lot of money rushing into the put saying, I got to protect myself, it creates the very selling that they're protecting themselves from. And the further down the market goes, the higher this delta becomes, the more they have to sell the market to increase their negative delta, and on it goes. So there's that part. There is just simply the selling because, oh my God, I was wrong. There are the retail traders who got sucked into the narrative. They're usually the last ones to come in on these kind of short covering rallies in bear markets. They're usually the last ones to come in. And they have, like I said, they have weak hands, because as soon as they start losing money, they tend to bail very quickly. In my mind, it seems strange that Powell's comments could spark such movements in one day. Well, he knew exactly what he was saying, and he did it all in 8 minutes, because that's all he needed to say. And he basically told the markets, you're out of your mind if you think this is what we're doing. So if you're investing based on this story, you're an idiot, period, and I'm going to hurt you. That's basically what he said, and that was it. That was all that was needed. Are there really that many big players with knowledge of what we have been discussing here for months that would then move such significant amounts of money outside the market based on this news? Yeah. Sometimes to get something going, like an avalanche, all you need is a small snowball rolling down a mountain. And as it starts to gain more and more size and mass, it can cause a whole bunch of things to happen. These markets are complex social systems defined by a lot of non-linearities. So sometimes it's hard to predict exactly what one thing will cause, but usually once a cascade starts going, it tends to continue in that direction, especially if it's fueled by a lot of put buying. As a European investor that wants more exposure to US and Canadian securities, the mid to short-term currency risk is fairly significant. I believe the euro will eventually appreciate again. Yet the ECB has been very careful with the rate hikes up until now. Up until now, you're right. I do not want to halt my investing, but I do foresee significant currency losses if I invest sizable amounts of money in the upcoming months. How do you build into positions while hedging out the currency risk? Well, it's a continual process, right? The way I do it in the US to avoid a lot of, if I want exposure to something for a long period of time, I'll buy it. So if it doesn't pay a dividend, I don't mind buying the stock directly, because I don't have to worry about much. I don't have to worry about the withholding and losing that tax on that side. And if I don't like the currency exposure, I can hedge out the currency exposure. It's a continual adjustment. You're never gonna, again, it's, you're not looking for two decimal places here. You're looking to be in the neighborhood. A great way to get exposure to the U.S. Without having U.S. dollars at risk. Other than the profit you make. In other words, you're not going to risk your capital. You're not going to convert euros to US dollars. You're just going to say, look, I'm going to invest nothing in the US. I'm going to convert nothing, but I'm going to generate profit in the US, and that profit I don't mind currency risk on. Is use the options and use leaps. These are long-term options of at least a year, and then create a synthetic. Just create a synthetic. If you have interactive brokers from where you are in Europe, you should be able to trade the US markets, and whatever euros you have in your account will act as margin against the synthetic position that you created. You don't actually have to have US dollars. And the synthetic, if you do it correctly, will be free in terms of the currency that you have to pay. You'll have to post margin. But if you can use over leveraged synthetics, if you want to create a spread that gives you US dollars in your account so that you do have some US dollars in there, however you want to do it. But you can use synthetics. Now, the nice thing about the synthetic is any dividend is already in the option price. So if you create a synthetic by combining the put and the call, you have the present value of the 1-year dividend within the option price, thereby giving you the dividend without the withholding tax. And without it being a dividend, it's now a capital gain, and without the currency exposure at the same time. So you can use a synthetic to get that done. Whew. And that brings us to the end of it all. What is this, over an hour and 15 minutes? 20 questions. They were good questions this week. Very good questions. Let's hope this continues.